Hi everybody, and welcome back to my channel. Today we are going to be talking about IBR loans, which is a loan repayment program that you might be looking at to reduce the amount of your monthly payment. I'm Melissa Ford. Welcome to Damsel of Success, where we talk about all things money. Please be sure to like and subscribe and hit the bell to be notified when I post a new video. So let's talk about IBR loans so that you can figure out if it's a good choice for you to use one or not. The first thing that you need to know about IBR loans is that they are not a temporary solution to a temporary problem. It's not forbearance, it's not deferment. Those are things that you would pursue if you had a temporary issue with paying your student loans. And this isn't that. It's a long-term solution, 20 to 25 years, based on a couple of factors, which we'll get into later. An IBR loan is also not the loan rehabilitation program, which is something that you'd be pursuing if you were in default on your student loans. The IBR loan falls under a group of loans called Income-Driven Repayment Plans, and the IBR loan stands for Income-Based Repayment. And like you probably already know, this is a plan that helps make your payments more affordable. In fact, it's based on 10 to 15% of your discretionary income. And we'll figure out whether it's that 10% number or 15% number in a little bit here. And unlike your standard repayment plan, where you'd be paying off your loan in 10 to 12 years, this is a 20 to 25 year repayment schedule. And again, we'll figure out whether it's 20 or 25 years in a minute here. So what is so great about an IBR loan? Other than the fact that it reduces the amount of your monthly payment, or most likely will reduce the amount of your monthly payment, it also has one really great benefit, and that's that at the end of the term of the loan, if you have a balance remaining, it is completely forgiven. Now, like we said, that loan period is going to be either 20 or 25 years, but at the end of that time period, if you still owe money on your loan, well, the federal government says, nope, not anymore. That balance is completely forgiven. Now, that does come with a little bit of a caveat. If you have an amount that is forgiven at the end of your loan term, well, that amount is going to be added to your taxable income for that year. So for example, if you had a balance left over at the end of your loan term of $10,000 and you were in a 25% tax bracket, you'd end up paying $2,500 in taxes on that money because it was added to your income for that year. So depending on your loan and your circumstances, you might want to look a little bit ahead and start saving up for that tax bill if it's going to come. But there are some other things that are really great about an IBR loan. One thing is that your payment is capped. So what does that mean? Well, under a standard loan repayment plan, you'd be paying off your loan in 10 to 12 years, and so the amount of your monthly payment is going to be higher. But under an IBR, your income determines how much your loan payment is going to be. And if your income ever increases to the point where you'd have to pay more than what you would have paid on your standard loan, well then that's the max. That's the maximum you would ever have to pay, is what you would have paid under your standard loan repayment program. So if your standard repayment plan was at $500 a month and your income rose to the point where you could conceivably afford $1,000 a month, well, you wouldn't be owing $1,000 a month. You would only owe that $500 a month. Another great feature of the IBR plan is that your interest doesn't capitalize. So what does that mean? It's kind of a technical term and it can get a little confusing, so let's talk about it. So basically, you can think about your loan, the amount that you owe, being in two different buckets. Bucket number one is the amount that was dispersed to you, or the amount that you took out on a loan. So let's say that's about $45,000, right? The second bucket is the amount of interest that's accrued on your loan. So let's say that's $10,000. Now, if your interest capitalizes, what it does is it combines those two amounts. So the amount of interest that's calculated would then be calculated based on a total amount of $55,000. But when it doesn't capitalize, it keeps those buckets separate. So no matter how much your interest grows, the only thing that you're going to be charged charged interest on is that original amount, or however much you've paid down from that original amount, and that never grows as long as it's not capitalized. So over time, you can kind of see how adding extra interest to that balance would kind of exponentially increase how much you would owe in total on that loan. But thankfully, with this loan, the interest does not capitalize. Another really great thing about the IBR loan is that your payment amount is based on a percentage of your discretionary income. And we'll get into how to calculate that in a minute. But the thing that I want you to know right now is that a lot of these IDRs, or income-driven repayment plans, have different percentages that your monthly payment will be based on. And in this case, the amount is pretty low. It's either 10% or 15% of your discretionary income. Additionally, the loan period is 20 to 25 years. It's 20 years if you're only looking to repay undergraduate student loans, and it's 25 years if any of your student loans are for postgraduate studies. Another great feature of this loan is how it calculates your discretionary income if you're married. So if you have a spouse, sometimes these IDR loans will take your combined income to calculate your discretionary income. But for an IDR loan, if you decide to file separately rather than married filing jointly, you have the option of not including your spouse's income into your discretionary income calculation, which could be beneficial to you if you have a spouse that makes significantly more money than you do. Now, definitely consult a tax professional before you make a call about any of those things, because there are other repercussions that are going to apply, whether, based on whether you file jointly or separately. But just know that with an IBR loan, it is an option to you to exclude your spouse's income. So what are some of the downsides of going with an IBR loan? Well, there are some things about income-driven repayment plans altogether that are a little bit of a downside that you need to consider. Mostly is that it's going to take a lot longer to repay your loan. So instead of paying it off in 10 to 12 years under a standard loan repayment program, you're looking at 20 to 25 years of time when you're going to be paying a student loan bill. And of course, because that time is much longer, there is more time for interest to accrue. So the total amount that you're going to spend on your loan will definitely be higher. Another thing to be aware of with this kind of loan is that it's actually pretty likely that you're going to be able to pay off the loan before the time that, you get eligible to have any of it forgiven. So that big benefit at the end where, you might have a balance that's forgiven, it's really possible that that may not apply to you at all. And if it does, like we talked about before, that amount will be added to your income for that year, and you will be required to pay taxes on it. Lastly, with an IBR, there's another small downside, and that's that it has different eligibility requirements. And if you don't meet the highest standard of eligibility, then you're going to be paying a little bit more than some of the other plans might charge you. So there are a couple of other plans out there that offer a 10% of your discretionary income. That's how they calculate what your monthly payment will be. And in this case, if you don't meet that highest standard, it could be up to 15%. So let's talk about if you're eligible for an IBR. Well, first, like all IDR loans, it is important that your loan be federally backed, not privately backed. Next, you can't be in default on any of your student loans in order to qualify for this program. If you are, then you want to look into something called the Loan Rehabilitation Program, which will kind of help you get to a place where you would be eligible for one of these programs. Additionally, with an IBR loan, you must demonstrate something called partial financial hardship. And that is something I'm going to define for you in a minute, but just know that you must demonstrate partial financial hardship. And in order to qualify for that lower rate of your discretionary income, that 10% rate, you have to be considered something that's called a new borrower. And that is something that we'll get into in a minute as well. I'm going to define those terms for you, but just remember those two terms. You're going to be considered a new borrower, and you have to demonstrate partial financial hardship. And last but not least, there are specific loans that are eligible or not eligible for this kind of repayment program. So I'm going to put a chart up here to show you exactly what those are. So eligible loans include direct subsidized loans, direct unsubsidized loans, direct loans made to graduate or professional students, direct consolidation loans that did not repay any PLUS loans made to parents, subsidized federal Stafford loans from the FFEL program, unsubsidized federal Stafford loans also from the FFEL program, FFEL PLUS loans made to graduate or professional students, and FFEL consolidation loans that did not repay any PLUS loans made to parents. If you consolidate, additionally, a federal Perkins loan is eligible if you consolidate it first. Loans that are not eligible under an IBR program include direct PLUS loans made to parents, direct consolidation loans that repaid PLUS loans made to parents, FFEL PLUS loans made to parents, and finally, FFEL consolidation loans that repaid PLUS loans made to parents. So let's talk about what those two terms mean that I mentioned. Number one is the new borrower term. You're considered a new borrower only if you meet two conditions. The first condition is that you did not owe any money on any federal student loan prior to October 1st, 2007. The second condition is that you also have to have received a disbursement of a loan, meaning you got the money for the loan, after October 1st of 2011. So if you don't meet those two conditions, you are not considered a new borrower. And under the terms of an IBR loan, that means that you would only be eligible at that 15% rate. Now, if you do qualify as a new borrower, then you would be eligible at that 10% of discretionary income amount. Next, let's talk about what it means to demonstrate partial financial hardship. This one is a lot easier. So to demonstrate partial financial hardship, all you have to show is that the amount that you pay on your standard repayment plan, that would be that 10 to 12 year repayment plan, is greater than 15% of your discretionary income. And it's a good chance that if you're already struggling with your payments, that you'll meet that qualification. But it's not guaranteed, so you do need to make that calculation on your own to figure out if you're going to qualify for an IBR. So probably the biggest question on your mind right now is how much you're going to pay every month if you go with an IBR loan. There's actually a formula that you can use to calculate that, which I'm going to put up on the screen. Now, I'm just going to show it to you for now and tell you about it, but we're going to go into an example of how to calculate this in just a moment. So let's take a look at that formula. What the formula is going to do, it's going to take your AGI, or adjusted gross income, which you can find on your 1040 tax return form on page 1, line 11. So you're going to take that AGI, subtract the federal poverty line times 150%. Then with that balance, you're going to multiply that balance by either 10% or 15%, depending on your qualifications, whether you're a new borrower or not. Then with that balance, you're going to divide that number by 12 to get your monthly payment. Now, I know I just threw a lot of math and a lot of terms your way, but I promise I'm going to give you an example of how to calculate this in just a second. But first, I want to show you what the federal poverty line number is and how to find it for yourself. Now, I've talked about this already in some of my other videos on student loan repayment plans, but just prepare yourself because the federal poverty line was shockingly low. When I looked at it, I can't imagine anyone surviving on that amount of money every year. So just keep that in mind. Here is what the federal poverty line looks like. So as you can see on this chart, the poverty line grows with your household size, and it starts at one person with no dependents. And that number is $12,760. Apparently, if you make $13,000 a year, you are above the federal poverty line, which, like I said, I don't get how they get there, but that's the number that we have to use for this calculation. So let's get into an example of how to calculate all of this now that we have all your information. We're going to make some assumptions here in this example, just, so you can have an idea of how this works. And here are the assumptions that we're going to make. Oh, and one other thing that I forgot to mention earlier is that that federal poverty line applies to you in every state except for Alaska or Hawaii. So if you live in Alaska or Hawaii, you're going to need to consult your own state on what they consider the federal poverty line to be there. But back to these parameters we're going to use to calculate what a loan payment would look like. So we're going to say, first of all, that you're single and that your family size is 1. We're going to say that you don't live in Alaska or Hawaii, and so the regular federal poverty line number will apply to you.
We'll say that you have a $45,000 student loan, which you'll repay over a period of 10 years at a 6% interest rate.
And we're going to list your adjusted gross income as $40,000. We're also going to assume that your income is going to grow over time. So for the purposes of this example, we're going to say that it's going to grow at a 5% rate every single year, which interestingly enough, is actually the result of a study that was done by the Federal Department of Education and the Federal Department of Treasury to see, on average, how much your salary will grow with a college education. And the average is 5%. We're also going to assume that you qualify as a new borrower at that 10% rate and that you're only paying off undergraduate student loans, no graduate student loans. So based on all of those parameters, we know that your federal poverty line number would be $12,760. So now that we know all of the information and all of the parameters, let's take a look at that formula that I told you about earlier and apply all of that data, and I'm going to walk you through this example step by step so that you know how to calculate it for yourself. So the first thing we're going to do is to take that federal poverty line and multiply it by 150%. That will give us a total of $19,140. Next, we're going to take the adjusted gross income, or AGI, and we're going to subtract that $19,140. So taking that $40,000 AGI minus $19,140, that gives us $20,860. And that is what is considered your discretionary income for the whole year. So then we're going to take that amount, that discretionary income amount, and we're going to apply the rate that this loan allows for. And in our case, for example, that rate is going to be 10%. So what is 10% of $20,860? Well, that amount is $2,086. And that amount is what you would owe the whole year. So in order to get a monthly payment, all you have to do is divide that number by 12, which gives you a monthly payment of $173.83. Now, based on our example, had you been repaying that loan under a standard repayment plan, that 10 to 12 year repayment plan, well, your payment would be $500 a month. So that is a big difference with the IBR plan. It really cuts down that monthly amount that you're devoting to student loans. The whole point of these plans is to make that payment more manageable to you. But like I said, there are other considerations with these loans. So I want you to pay attention to all the factors, not just that monthly amount. So let's take a look at how an IBR loan kind of plays out over time. As we already calculated, we can see with this example that our first payment is $173.83. Now that amount is going to rise with your income. So your last payment would be $500 a month because we're assuming that your income is growing over that 20-year period, and at some point you're going to transition over to paying that capped amount of $500 a month because that is what you would have been paying on that standard repayment plan, which means that you would actually be paying off this loan for the entire term of the loan of 20 years. Your total payments would add up to $81,706, and you would have an amount that would be forgiven. So you would have $7,703 that would be forgiven and added to your taxable income. So assuming that you are in a 25% tax bracket, and who knows what you'll actually be by that time, we're talking about 20 years in the future. So like I said, this is just an example. You can't take this word for word. I just want to give you an idea of what this might look like. So in that scenario, you would be paying $1,925.75 in taxes on that forgiven amount, which means that the total amount that you would pay for this loan is $83,631.75. So that's a pretty significant amount to pay for your student loans. In fact, it's getting real close to being double the amount that you borrowed. So that's a factor. It's something you really need to consider. And I would really encourage you also to make sure that you're looking at all of the IDR program loans and taking a look at what's going to be best for you, because they have different terms and you might find that one is better suited than another. In this series, I'm going through all of those IDR loans, but if you want to get a really good sense of what they kind of all look like compared to one another, then check out this video, which I will link above. Now, I know that was a lot of math to calculate, but the good news is that the federal government has actually made this process pretty simple for you. If you go to their website, I'm going to put a link in the description below, you can find something called their loan calculator, and that is going to let you input your personal information, even draw in your current student loans, and compare what all of these different plans might look like for you. And that'll give you all the information that you need to make a decision about, if you want to pay more over time, if you want a shorter loan, if you want a longer loan. So I'd highly encourage you to check out that link in the description below and go to the website and see what makes sense for you. So what else should you know about the IBR loan? Well, there's one big thing that we haven't talked a whole lot about, and that's the recertification of this loan. You must recertify this loan every single year, and your loan servicer will reach out to you to make that happen. But it's really important that you follow up with them and make sure you're giving them the information that they request from you. Because if you don't, there are certain penalties that could be assessed. So for an IBR loan, there are two big penalties that are assessed. Number one is that if you don't recertify by the deadline, your payment will automatically shoot up to that capped amount of what you would have been paying on your standard student loan. Like in the example we've talked about already, instead of paying $173-ish a month, your payment would boost up to $500 a month. So the other penalty is that your loan interest will capitalize. Like we talked about before with those two separate buckets, those buckets are going to be merged. And so the interest that you're charged will be calculated based on the total amount rather than just the principal balance that you might owe. And that's going to make your loan a lot more costly over time. So it is really important that you respond to your loan servicer every single year and stay on top of getting that recertification. Now, another thing to be aware of is that if your circumstances change, you can actually recertify at any time. So if you lose a job or your income goes down or you add another dependent to your family, let's say you have a child, then you might be eligible to pay a lower rate every single month. And like I said, you can do that at any time. All you have to do is reach out to your loan servicer and give them your new details. So at this point, you might be asking yourself, how do you get one of these IBR loans? How can you make this happen? It's really simple. All you have to do is reach out to your loan servicer, whoever owns your loan right now, and they will walk you through the process that you need to do to qualify for one of these loan repayment programs. It's actually super simple, and they make it simple because it's a win-win. It doesn't just benefit you, it benefits them as well, because it's much better for them if you can continue to make payments on your loan, even if they're less, rather than, taking on an amount that is impossible for you to pay and not paying anything at all and letting it go into default. Your loan servicer would much rather you pay something every month, rather than not paying anything at all. And that is why, they're going to be really willing and able to work with you. So that is everything that I know about IBR loans. Hopefully it has helped you figure out whether it's going to be right for you or not, and whether or not it's going to help you reach your financial goals. That is something that I talk about on my channel all the time. So if you dig talking personal finance, you're in the right place. I definitely love talking about that stuff. That's what my channel is all about. I talk about investing, I talk about retirement, I talk about debt payoff, I talk about how you can set and reach financial goals. So definitely give my channel a look if that's something that you're interested in. So all you have to do is hit that subscribe button and hit the bell so that you get a notice every time that I post a new video, which is about once a week. And it would also really help me out if you like this video, if it was helpful for you, then please hit that like button. It actually is super important and helps me out a ton. So I appreciate it. If you liked it, hit like. So I'm doing this whole series on these repayment loans, and I'll be releasing another one in about a week. So stay tuned for that. In the meantime, I hope you have a lovely week, and I will see you soon. That is all for now. Bye-bye.